Binder Hamlyn page 1. Mineworkers Pensions Standard Note, SN/BT 1189 last updated, the 31st of March, 2010 Author, Junith Early Section Business and Transport Section. This note summarizes the arrangements made for the Mineworkers Pension Scheme, MPS, and the British Coal Staff Superannuation Scheme, BCSSS, at the time of privatisation of British Coal. The two schemes were closed to new members and new contributions, and they and their assets were separated from the corporation as stand-alone trusts. The schemes were valued in 1992 to 93, with half of the surplus allocated to the beneficiaries and half to British Coal. An investment reserve was established, using British Coal's share of the surplus, which would be used to make good any deficit which should arise. This investment reserve is to be transferred to the government over a period of some 25 years, with the scheme's actuary deciding how prudently this could be done. The government stands as guarantor to the scheme, ensuring it is always able to pay the benefits promised in the rules of the scheme, including the annual indexation of guaranteed pensions in line with price inflation. In return, the government receives, over a 10-year period, a 50% share of any valuation surpluses disclosed after the 31st of October 1994. The remaining 50% is allocated to the scheme's bonus augmentation funds and may be used to improve benefits. The government does not guarantee these bonuses, but should a deficiency arise in the bonus augmentation fund, it does guarantee that pensions will not fall in cash terms. The Coalfield Communities Campaign, CCC, has campaigned for the arrangements to be re-examined and the surpluses in the schemes to be reapportioned. The government responded by agreeing to review the arrangements, but in 2003 decided against a change to the 50/50 division in the light of the poor investment performance of the funds. Valuations in 2002-03 showed both schemes to be in deficit, requiring payments were made from the investment reserve. Subsequent valuations in 2005-06 found both schemes to be in surplus, allowing the level of the investment reserve to be restored and improvements to be made to scheme members' benefits. Although the terms of the guarantee were again questioned, the government has not indicated an intention to change the arrangements. The 2008/09 valuations showed both schemes to be in deficit. This information is provided to members of Parliament in support of their parliamentary duties and is not intended to address the specific circumstances of any particular individual. It should not be relied upon as being up to date. The law or policies may have changed since it was last updated, and it should not be relied upon as legal or professional advice or as a substitute for it. A suitably qualified professional should be consulted if specific advice or information is required. This information is provided subject to our general terms and conditions which are available online or may be provided on request in hard copy. Authors are available to discuss the content of this briefing with members and their staff, but not with the general public. Contents 1. Arrangements at the time of privatization. 3. 1.1 How the government guarantee works. 4. 2. Campaign to change the arrangements. 5. 2.1 The government's initial response. 6. 2.2 Sacked miners. 9. 2.3 Low pensions and review of guarantee arrangements. 9. 2.4 Progress on the review. 11.3 2002/03 Valuations. Schemes in deficit. 13.4 2005/06 Valuations. Schemes in surplus. 15.4.1 Comment. 17.4.2 Payments to the government since privatization. 25 2008/09 Valuations. Schemes in deficit. 21. 5.1 Mineworkers Pension Scheme. 21. 5.2 British Coal Staff Superannuation Scheme. Arrangements at the time of privatization. Two pension schemes operated under British Coal, the Mineworkers Pension Scheme, MPS, and the British Coal Staff Superannuation Scheme, BCSSS. As part of the privatization, the schemes were closed to new members and new contributions. A successor scheme was set up to replace the MPS and BCSSS. This left the MPS and BCSSS with substantial assets, and members who were either pensioners, that is being paid a pension from one of the schemes, or deferred pensioners, not still contributing, but not yet drawing a pension. The structure of the schemes was altered and new arrangements were made for pensions from these schemes in an agreement between the trustees of the scheme and the government, replacing British coal. The arrangements included a government guarantee of some of the scheme's benefits and a procedure for dealing with surpluses from the schemes. In the case of the MPS, the scheme's surplus was to be calculated at the 30th of September 1993. Half of this surplus would be allocated to the beneficiaries and used to improve benefits, the other half would be allocated to British coal. British coal's unused share of this surplus would be used to set up an investment reserve, which would be available to make good any deficit which should arise in the fund, and protect bonus increases which were paid as part of the benefits. The investment reserve would gradually be transferred to the government over a period of 25 years, or such longer period as the government might from time to time determine, with the scheme's actuary deciding how much could prudently be transferred at each triennial valuation. In addition, any surpluses that arose in the fund in the future would be split between the beneficiaries and the government in equal shares. The government stands as guarantor to the scheme, ensuring that it is always able to pay the benefits promised in the rules of the scheme, including the annual indexation of guaranteed pensions in line with price inflation. The remaining 50% is allocated to the scheme's bonus augmentation fund and may be used to improve benefits. The government does not guarantee these bonuses, but should a deficiency arise in the bonus augmentation fund, it does guarantee that pensions will not fall in cash terms. Similar arrangements apply to the BCSSS, except that its surplus was allocated equally to beneficiaries and British coal as at the 5th of April 1992, and the possibility of a further valuation on 5 April 1994, in the same proportions, was provided for. These arrangements were described in an exchange of letters between then Energy Minister, Tim Egger, and the chairman of the two schemes 1. And in a written answer from Mr. Egger in April 1994.2. The arrangements providing for the pension funds after privatization are contained in Schedule 5 to the Coal Industry Act 1994. The detailed modifications of the individual schemes, which provide for the allocation of the surpluses, were made by regulations under the Act. The British Coal Staff Superannuation Scheme, Modification, Regulations 1994 and the Mine Workers Pension Scheme, Modification, Regulations 1994. 3. The National Audit Office report on the sale of British coal published in 1996 summarised the surplus sharing arrangements and noted that the government's guarantee would be a significant reassurance to pensioners and other members and, given the uncertainty of future investment performance and inflation, could give rise to government payments in some future years. 1.1 How the government guarantee works. The Mine Workers Pension Scheme 2007 report and accounts contained the following summary of the guarantee arrangements. In principle, the terms of the guarantee are that government guarantees the solvency of the scheme so that, with the exception of bonus augmentations, it is always able to pay the benefits promised in the rules of the scheme, including the annual indexation of guaranteed pensions in line with price inflation. In return for the guarantee, government receives, over a 10-year period, a 50% Share of any valuation surplus is disclosed after the 31st of October 1994. The remaining 50% share is allocated to the Bonus Augmentation Fund, and, subject to the approval of the guarantor, can be used to improve benefits. Bonus augmentations are covered by a lesser guarantee, to the extent that in the event of a valuation shortfall in the Bonus Augmentation Fund, the standstill guarantee comes into operation and the total amount of any pension payable from the scheme will not be allowed to fall in cash terms. To facilitate the operation of the guarantee, the scheme is notionally split into 4 sub-funds, detailed in the notes to the accounts. 3 of these are the Guaranteed Fund, from which the guaranteed benefits are paid, the Bonus Augmentation Fund, from which bonus augmentations are paid from the members' 50% share of surpluses, and the Guarantor's Fund, from which payments to government are made from its 50% share of surpluses. A 4th fund, the Investment Reserve, contains the unused balance of British Coal's share of pre-1994 valuation surpluses. To the extent that the investment reserve is not required to maintain benefits, it can be drawn down by government over a period ending no earlier than 2019. The rate of drawdown is determined by the scheme's actuary. In the event of a valuation surplus, 50% of the surplus in the guaranteed fund is credited to the Bonus Augmentation Fund, where it can be aggregated with any surplus in that fund and distributed to members by way of bonus augmentations, subject to the approval of the guarantor. The remaining 50% share of the surplus in the guaranteed fund is credited to the guarantor's fund and released to government as a stream of 10 annual payments. Any surplus in the guarantor's fund is used to top up payments already being made to government from previous surpluses. In the event of a valuation shortfall, the shortfall in the guaranteed fund is corrected. Firstly, by a transfer of assets from the investment reserve. Secondly, if the investment reserve is insufficient to meet the shortfall, by equal transfers of assets from the guarantor's fund and the Bonus Augmentation Fund. 1. And thirdly, if the transfers have not been sufficient, by the obligation on government to make direct payments to the scheme in 10 annual installments. Once a transfer has been made from the investment reserve, the first charge on any subsequent surplus in the guaranteed fund is to replenish the investment reserve so that it is in the position it would have been had the earlier transfer of assets to the guaranteed fund not been made. There is no provision in the guarantee arrangements for making good a shortfall in the Bonus Augmentation Fund. Bonus augmentations may therefore be eroded or withdrawn. The guarantee does, however, ensure that the total pension payable does not fall in cash terms. This works by reducing bonus augmentations each year by an amount equal to the index-linked increase paid on guaranteed pension in that year. This process continues until the bonus augmentations existing at the time a shortfall was shown in the Bonus Augmentation Fund have reduced to zero. If the assets in the Bonus Augmentation Fund are exhausted, any remaining liabilities in that fund are transferred to the Guaranteed Fund. 1. As soon as it becomes necessary to make these equal transfers, the scheme actuary must certify the balances in both the Guarantor's Fund and the Bonus Augmentation Fund to the guarantor. If the Bonus Augmentation Fund is greater, the guarantor is required by the terms of the guarantee to make payments into the Guarantor's Fund to bring it up to the level of the Bonus Augmentation Fund. These payments are to be made in 10 equal annual installments. 5. 2. Campaign to change the arrangements. Valuations of the schemes were carried out by the government actuary in 1996 and 1999. On both occasions the schemes were found to have large surpluses. The government's share of any surpluses is drawn from a guarantor's fund and allocated over a 10-year period. The reply to a PQ answered on the 1st of April, 2004 gave the cash value of receipts to the government from surpluses from the two schemes since payments began in 1996 to 97. 6. Please see the appendix for the page on the next slide. %11.0% in 2018. The Coalfields Communities Campaign, CCC, is a national campaign to defend and promote the interests of communities affected by change in the coal mining industry. In 1999, it published a report, It's the Miners' Money, which argued that the size of the surpluses on these valuations and the projected future levels of the surpluses were larger than could have been anticipated at the time of the privatization. The risk for the government in terms of guaranteeing an increase in line with the RPI was no longer a great one, and therefore the arrangements should be reconsidered. The campaign's proposals were summarized in the report. The guarantee was struck on actuarial advice. Hindsight may have shown that the advice was too cautious, but that is now history. The point is that the funds are in a robust financial position, and under the current arrangements the government has no real liability. The fears expressed at the time of privatization no longer carry the same weight. No one is suggesting that the guarantee should be abolished. It provides security for the pensioners, and a greater degree of freedom in the fund's investment strategy. No one is suggesting either that the government should receive nothing in return. What is at issue is the reward which the Treasury receives for providing the guarantee. At a 50% share of an unexpectedly large surplus, it is too much. 9. The report also pointed to the relatively low level of pensions payable, particularly from the MPS. This was because the scheme did not become earnings-related until 1973. According to the CCC, the average pension within the scheme was £38 per week at that time. The CCC argues that a greater proportion of the surplus should be retained by the schemes. To help the poorest pensioners, it also advocated increased investment in coalfield communities. Any surplus paid to the government from the pension funds is returned to the consolidated fund, the government account into which most revenue from taxation and other money payable to the exchequer is paid. However, the government has referred to these surpluses on previous occasions when allocating money to coalfield communities. In December 1998, a press release said that £350 million was to be allocated to coalfield communities, and of this sum £10 million will be an endowment which recognises the surpluses that the government has received from the miners' pension funds. 10. 2.1 The government's initial response. The government made an initial response to the CCC's campaign in December 1999. A DTI press release stated, Energy and Competitiveness in Europe Minister Helen Liddle gave her initial response to the Coalfield Communities Campaign, CCC. The CCC document argues for a reduction in the government's share of coal pension scheme surpluses. The previous government at the time of privatization of the industry was given a 50% of surpluses in return for a guarantee which underwrites the benefits retired miners receive. 8. http://www.be.gov.uk/energy/sources/pensions/index.html, retrieved 2 June, 2008. 9. CCC, It's the Miners' Money. Miners' Pension Fund Surpluses and the Treasury's Windfall, 1999. The full document may be obtained from the CCC at 9 Regent Street, Barnsley, S70, 2EG. Tender press release, multi-million-pound package for the coalfield communities, the 1st of December, 1998. Mrs. Liddell said, "This is an important document. We will certainly study it carefully, as I am sure will the trustees of the two coal pension schemes." Mrs. Liddell also commented on the government's attitude to the guarantees which underwrite miners' pensions. She said, "The guarantee arrangements are for the long term. But recent surpluses must be considered against earlier large deficits, which the government continues to fund and which, conceivably, could happen again. The present arrangements were negotiated at the time of privatization. They are the envy of all other mature pension schemes, and we should be cautious about any reshaping of them. Retired miners are getting a good deal. Their pensions have increased by 20% in real terms since privatization. But security of their pensions is also important to miners and important to me." The minister said she was willing to consider creative suggestions. There may be other ways in which government and trustees can build on the present 50/50 sharing of surpluses. Perhaps a more ambitious investment strategy or an extension of the guarantee would provide more opportunities. We will continue to work constructively with the trustees in exploring how to generate continuing growth in pensions benefits. This government shares the aspirations of the coalfield communities to develop new jobs and infrastructure as mining declines. The DTI are working closely with John Prescott and his team on this. However, she noted that it would require primary legislation to divert the pension fund surpluses for this purpose. Notes to editors. Under arrangements negotiated with the trustees of the two coal pension schemes in 1994, the DTI agreed to guarantee pension liabilities which now total some £17.5 billion, and to protect them against future inflation. In return, the DTI receives 50% of any surpluses declared. Since 1994, the DTI has paid almost £400 million to cover pre-privatisation deficiencies, and has received £519 million as its share of post-1994 surpluses. The remaining surplus has been used to increase mining pensions by 20% over and above inflation. Further actuarial valuations are due shortly, although it is premature to assess the size of any fresh surplus. Under the 1994 Coal Industry Act, surpluses received by the DTI must be paid over to the Treasury's Consolidated Fund. The Treasury have agreed that they may be retained by the DTI to offset expenditure on liabilities inherited from British Coal. 11. In a written answer in June 2000, Helen Liddell confirmed that the DTI had no statutory powers to divert pension surpluses for regeneration. Coalfield regeneration. Mr. Catton, to ask the Secretary of State for Trade and Industry if he will utilize part of the share of surpluses generated by the Mine Workers' Pension Scheme and British Coal Staff Superannuation Scheme, taken by the government, to help regenerate coalfield community areas. 123,461. Mrs. Liddell, holding answer the 23rd of May, 2000, surpluses in the former British Coal pension schemes are split 50/50 between the membership of the schemes and the DTI, in its role as guarantor to the schemes. 11 DTI press release, statement by Helen Liddell on coal miners' pension funds, the 8th of December, 1999. In accordance with the Coal Industry Act 1994, SCH 5, paragraph 2, 10, all surpluses received by the Secretary of State must be paid into the Consolidated Fund. The DTI has no statutory powers to divert pension surpluses for regeneration. The government are already providing substantial funds to meet the commitments made in response to the Coalfields Task Force report, and indeed we announced in December 1998 a comprehensive investment package for coalfield areas worth £354 million over 3 years. In addition, the Secretary of State announced on the 17th of April the intention to make substantial sums available to the coal industry in the form of subsidy. 12. Mrs. Liddle had set out the government's position in more detail in reply to APQ on the 25th of May 2000. Mr. Catton, to ask the Secretary of State for Trade and Industry what plans he has to reduce the percentage of the surpluses from the mine workers' pension scheme and British coal staff superannuation scheme taken by the government. Mrs. Liddle, since 1994, the DTI has acted as guarantor to the former British coal pension schemes. In doing so, it underwrites 100% of any downside risk to guaranteed benefits in the event of scheme deficits. The guarantee means that basic pensions will always rise at least in line with inflation and will never fall in cash terms. In return, the government receive 50% of any actuarial scheme surpluses, the remaining 50% being available to the scheme trustees for distribution among their memberships. The government have no plans to reopen the guarantee arrangements, but it is discussing with the trustees whether there are opportunities to build upon them to the mutual benefit of scheme members and government. 13. Michael Clapham MP put down EDMs in support of the Coalfields Communities campaign in the 1999/2000 and 2000/01 sessions. 14 and John Cummings MP put down an EDM in the 2001/02 session which attracted 68 signatures. The motion read that this House recognizes that the 50% clawback by the government of any surplus of the mine workers' pension and superannuation scheme is grossly unfair, and invites the government and the trustees of the pension and superannuation scheme to enter into negotiations and agree upon a more just apportionment of the surplus and so enhance the pensions of thousands of retired mine workers and widows. 15. The actuarial valuation of the MPS published in September 2000 disclosed a surplus of £1,050 million to the 30th of September 1999. In a press release on the 8th of August 2000, Helen Liddle, Energy Minister at the DTI, stated that the scheme trustees had decided, with the agreement of the government as guarantor of the scheme, that the bulk of the members' share of the surplus should be used to provide a 9% increase in pensions in payment and deferred pensions. 16. 12 HC Deb 5 June 2000 C108W 13 HC Deb 25 May 2000 C595W 14 EDM 264 of 1999 to 2000 and EDM 184 of 2000 to 1. 15 EDM 149 of 2001/02. 16 DTI press release, Liddle welcomes boost for miners' pensions, the 8th of August, 2000. 2.2 sacked miners. On the 11th of December, 2001, the government announced that some of the miners dismissed during the 1984/85 miners' strike and not reinstated would be given enhanced pension rights. The cost was to be met from the residual assets of British Coal. Mr. Kevan Jones, to ask the Secretary of State for Trade and Industry if she will make a statement on the pension rights of miners dismissed during the 1984-85 Strikes 22,728. Mr. Wilson, following the consultation process last year, I am persuaded that a number of miners dismissed in connection with the 1984-85 strike, and not subsequently re-employed by British Coal, were harshly treated. I have concluded that the most appropriate way forward would be to enhance the pensions of these miners in recognition of the years of further service they lost as a result of British Coal's decision not to re-employ them. The costs of this will be met from the residual assets of British Coal. I would emphasize that those whose offences involved serious acts of violence or intimidation, or actions which jeopardized the safety of others will not qualify for this enhancement of pension. I will shortly be writing to interested parties with details of how this will be put into effect. 17. Apparently, of the 1,000 or so miners sacked in connection with the strike, only 335 were not subsequently re-employed. It is these 335 ex-miners who will be eligible for pension enhancements. Brian Wilson wrote to the Coalfield MPs on the 19th of April, 2002 to outline the details of the compensation scheme. Former miners who were sacked and not reinstated would be eligible for a 5-year enhancement to their pensions, as long as this does not increase their service to above the maximum. However, miners who were dismissed as a result of actions which seriously threatened the safety of others, or major theft, would not be eligible. The closing date for the scheme was the 31st of December 2002. 2.18. 2.3 Low pensions and review of guarantee arrangements. The government responded to the Coalfield Communities campaign on the 17th of January, 2002. First, it announced that it would pay one-off lump sums to pensioners who were on low pensions as they had built up their pension rights when the scheme was flat rate. The payments were to be made from the government's share of the surplus. Second, it announced that it would be reviewing the guarantee arrangements made at the time of privatization. Mr. Ilsley, to ask the Secretary of State for Trade and Industry if she will make a statement on the government's entitlement to half of the surplus of the mine workers' pension scheme. Mr. Wilson, I am pleased to announce a new, additional benefit for members of the mine workers' pension scheme on the lowest incomes, at a cost of £90 million. This will be funded out of the government's share of the scheme's reserves. The package will help mine workers' pension scheme members who have only very modest miners' pensions, despite many years of service to the industry before 1975. Help for that particular group was identified as a priority in discussions with the 17 HC-Deb the 11th of December, 2001, CC 759-760W. 18 HC-Deb the 10th of March, 2003, C12W.